For detailed planning, Financial Mappers offers a number of solutions for your interest-earning assets. However, for simplicity, in the early stages of plan creation, keeping all your interest-earning or cash-type assets in the transaction account is a quick solution. For brevity, you will often see this group of assets referred to as cash or cash-type assets. The following assets are in this group: the transaction account, term deposits, bonds, managed funds where the division can be cash, domestic fixed interest securities and global fixed interest securities. This group of assets is called your defensive assets. For demonstration purposes, screenshots will come from a 20-year plan for a single person with only defensive assets. John Citizen is age 55 and has a salary of $120,000 and is saving 10%. John will retire at age 65, thus he will have a plan displaying 10 years each for the savings and the retirement phases. Financial Mappers has a special rule regarding the calculation of dollar value account cost. This rule states that where the income is less than the account costs are reduced to the value of the income. This rule was introduced to protect the calculations against user entry error or having the account enter negative balances. It is important to remember that in Financial Mappers, this is not an accounting type product, but rather than long-term cash flow modelling software. This is why we refer to the account where tax is calculated as the tax estimator. The program is sold outside Australia and has been developed for quick scaling to other country-specific tax rules. For this reason, you will find options not applicable to the Australian conditions. However, there may be times when you want to avail yourself of these options. Apart from real estate, which the program assumes is always taxed as income, you have three methods of calculating tax. These are taxed as income, the default option, specified tax rate, and tax-free. When taxed as income, the nominated values in the tax schedule will be used. The program defaults to the current Australian progressive tax scale plus an additional flat tax of 2% to cater for the Medicare levy. No allowance is made for pro rata rates for low-income earners or any surcharge on high-income earners, which various governments will sometimes apply. The progressive tax rates are listed for a selection of other countries. Where the option specified tax rate is selected, the items are kept in a separate section of the tax estimator and tax is calculated for each account by the nominated tax rate. In the tax estimator, the total tax on salary, investments and superannuation are calculated. The tax on income is proportionally allocated between investments and personal income. This personal income includes the nominated retirement income. The tax due on investments is deducted from the transaction account at the end of the year in which the tax liability occurs. This is an example of the tax estimator for this plan. The tax estimator is found on the chevron Reports. The investment plan is used for quick allocation of salary savings to investments. Each of the accounts ticked have a 20% allocation from the salary savings. There is no allocation to the bond account. The remaining 40% is transferred to the transaction account. The normal rule for the investment plan allocation is that funds are allocated on a monthly basis. The exception to this rule is the allocation of funds to term deposits and bonds. For the purpose of calculating income, the program assumes that all the value is allocated at the start of the year. If you want to be more specific, you could consider using the purchase of these assets within another account, say the cash account. The cash account would be where you would want to isolate funds which may be for special purpose such as emergency cash or saving for a deposit to purchase real estate. Savings of personal items such as car or holiday should not be included in this account. They are best saved for in the lifestyle goals where the saving is allocated to the budget. If the account has an existing balance, in this case $100,000, that value is entered. Note that on the tab Cash Account you can nominate the method of taxation. On the tab Account Costs, the program defaults to none. You can elect to calculate account costs as either a dollar value or a percentage of fund. The dollar values are not indexed. Where the percentage of fund is selected, the calculations are made on the value of the fund after annual transactions, including drawdown. On the tab Investment Returns, the default rate is 5.18%. This is the average 90-day bank bill plus 1% for the 20-year period from 2000. Interest rates default to being variable, however you can change that option to fixed. Accounts with fixed rates will not change if the income modulator is activated for cash accounts. Income from cash accounts may be transferred to the bank account. If the option to reinvest is selected, you can nominate a year in which you wish to transfer the income to the bank account. In this example, the income is going to be reinvested until year 11, the start of the retirement phase. In the drawdown, the number of years over which the funds are to last is nominated. The program always defaults to a drawdown of 25 years starting in year 1, but the drawdown is not activated. Deposits and withdrawals from the transaction account can be made on an annual basis. In this example, $5,000 is deposited in year 2. Note the index value is listed below the present value entry. Withdrawals are always listed as a percentage of the fund. In this case, 5% of the fund is withdrawn. Deposits are made at the start of the year and withdrawals at the end of the year. Deposits can also be made on a monthly basis from the investment plan. In this example, 20% of the savings from salary are allocated to the cash account. Note the transaction account graph showing these transactions. In Financial Mappers, a colour code has been developed and employed for all graphs. You will find after a short time you will recognise the colours and their meaning. You can almost read the graph like a story. In addition to the graph view, the data view displays the information in 5 yearly intervals. Because Financial Mappers is working on annual cash flows, it is not appropriate to have term deposits of less than 12 months. There could be value in using a cash account for your short-term TDs. For both term deposits and bonds, the program assumes interest is paid in the year it is earned. This allows a more accurate calculation of investment returns for the whole plan. Early withdrawals are not allowed. There are some differences between the term deposit and bond accounts. These are: term deposit income is paid at the end of the year to the transaction account. Bond income, twice yearly coupon payment, is allocated to the monthly income section of the transaction account. When the income modulator is activated, the interest rates for bonds do not change. When the income modulator is activated, the interest rate for term deposits will change to that of the first year of the TD and will remain at that same rate for the length of the time. For this term deposit, the account already has an existing 5-year term deposit. Additional term deposits of $20,000 are purchased from the transaction account in years 6, 11 and 16. If the term deposit is an existing term deposit, the value of the term deposit will be displayed as an asset at the start of the year before annual transactions. If the term deposit is purchased in year 1, the value of the term deposit will be displayed in the value of assets at the start of the year after annual transactions. In year 1, the bond account has no assets at the start of year 1. The $50,000 is used to purchase a bond from the transaction account. There is no allocation from the investment plan, thus the $50,000 is not visible as an asset until the start of year 2. With bonds, the program assumes that the income is paid as a twice yearly coupon. Therefore, the income is transferred to the transaction account and is listed as a monthly transaction so that the two payments are averaged for the calculation of income in the transaction account. This 10-year bond is a new account and has no current assets. The The 10-year bond, $50,000, will be purchased from the transaction account in year 1 of the savings phase. In year 1 of the retirement phase, a bond costing $30,060 present value is purchased. This is a future value of $50,000. No allocation is made from the investment plan. The program does not allow the early redemption of either term deposits or bonds. However, it is very important for you to understand the implications of the change in bond value if bonds are redeemed early. If interest rates rise, the value of the bond will fall. If interest rates fall, the value of the bond will rise. To accommodate this demonstration, the income modulator is activated using both a higher and lower interest rate. Unlike the term deposit account, interest rates on bonds do not change when the income modulator is activated. However, at the bottom of the data view, the value of the bond, if it is liquidated, is displayed together with either the profit or loss. On the income modulator, the change in interest rates has been a rise of 1% for the first 10 years and a fall of 1% for the last 10 years. A new bond is purchased in year 1 and year 11. The graph view demonstrates the profit above the y-axis and the loss below the y-axis for each year the bond is held. This demonstration is intended to show the risk of an investment in a bond fund where interest rates are expected to rise and stay high for a considerable time. Another alternative is to have a managed fund to hold your interest-earning assets. They could be included in a multi-sector fund. For this example, a managed fund called a defensive managed fund has been created with the current value of $100,000. Over the 10-year savings phase, 20% of the savings allocation in the investment plan will be allocated to this fund. There will be no purchases directly from the transaction account. The asset allocation is 20% to cash and 40% to both domestic and global fixed interest. The default rates for fees have not been changed, however these are most likely to be excessive for this type of fund. The investment return has been changed from the default rates. Note that a small amount of capital growth is included for the bond account. The dividends have been reinvested for the savings phase and transferred to the transaction account for the retirement phase. There will be no tax credits for this account. The drawdown will be activated using the default entries. The transaction account has been discussed in detail in the tutorial Budget, Investment Plan and Transaction Account Cash Flows. Here you can view the $50,000 to purchase the bond and the deposit of $5,000 indexed to the cash account in year 2. In the monthly transactions, the interest earned and the savings allocation are entered together with the interest from the bond. Interest from the term deposit is paid as an end-of-year transaction. Tax due on the earnings is paid at the end of the year. $50,000 is nominated as the retirement income in the retirement plan. Note that term deposits and bonds are not included. On maturity, the funds are deposited into the transaction account where they may be used as part of the drawdown. The drawdown values from the cash account and the managed fund are deposited into the transaction account at the start of the year. The nominated retirement income is withdrawn from the transaction account at the start of the year and transferred to the budget as income. Note that the tax due on that nominated value will be allocated to the budget, as this is now considered personal income rather than investment income. Values in this example have used present values. Using present values rather than future values for events into the future will most likely give you a clearer picture of what type of retirement income you can afford in retirement. Note the breakdown of the drawdown into investment income and investment capital. Any income not allocated from a specific account is withdrawn from the transaction account. On the Chevron Reports Plan Outcomes, detailed information is available in both data and graph view. Note that the interest-earning assets held in the Managed Funds account have been allocated to cash, term deposits and bonds. Also note that there are no growth assets and the investment profile is no growth. In Financial Mappers, you can use the income modulator to raise and lower interest rates. To access the income modulator, click on the link Modelling Tools are off. Note that once the modulator is activated, the sign will change to Modelling Tools are on. When any modulator or historical data is activated, the nominated rates are applied according to the rules for these accounts. The exception is the bond account. If interest rates on cash accounts or interest rates on loans are fixed for the nominated period of the year, then interest rates do not change. For more detailed explanations, refer to your tutorial. Financial Mappers is designed to be an educational and fun-to-use product. Sometimes it's not about creating complex investment strategies. It can also be about understanding the basic cause and effect of financial decisions that you make. We like to think you can use Financial Mappers as a doodle pad where you look at very simple concepts. Then you can try to understand what is likely to make the outcome better or worse for you.